you can see exactly around the 50 to 60 level the market started moving to the downside. You can also take this trade. Hello traders, welcome back to GolgiFx. This is your boy Golgi. So today we're talking about how to use Fibs in Forex using Fibonacci retracement. Let's get into it. Fibonacci retracement levels. So the Fib levels are horizontal lines that indicate where support and resistance are likely to occur. These levels are based on Fib numbers, which are in percentage. So we have the 23.6, the 38.2, the 61.8, and the 78.6 as the Fib retracement levels. Traders also use the 50 level of treatment level, which is also good. Let's look at calculating Fibonacci retracement levels. So there's nothing to calculate when it comes to Fibonacci retracement levels. They are simply percentage of whatever price range is chosen. They are based on something we call the golden ratio. So the golden ratio are sequence of numbers with zeros and the number itself. And we keep on adding the next number to get the next number. That is how basically the golden ratio works. Let's look at how this is useful. The indicator is useful because it can be drawn between two significant price ranges, such as the highs and the low. The indicator will then create the levels between these 2 points. So we can use this 2 points or these levels to determine our stop loss and our target profit levels. So as we are studying, we also have to know this. These levels should not be relied on exclusively because it is so dangerous to assume price will retrace after hitting a specific Fibonacci level. Also, Fib levels are static price levels that do not change. So as we move on, when we talk about trading psychology, you understand why it's very dangerous for us to rely solely on these levels. Traders, let's get on the chart. Traders, we are currently on the TradingView platform and on the 2 hours chart of the BTC USD. We are come to look at how to use the Fib levels. So let's get into it. So if you come to this point, you see the Fibs at the top here, and the next thing you can do is you can identify your market structure. So you can see that currently the market is in a downtrend if you look at this level. And why are we saying that? Because it's making lower lows at this level. So let's say if the market was around this level and we saw this move to the downside at this low. This is the low, this is the high. So you could have been looking at this level at the lower time frame to take a trade around this point. You should have able to take this trade here to make at least 1 to 3 risk to reward ratio here. So also if you look at this point, as you took this trade, you could have also been looking at this low, and as you saw the market consolidation here, you could have taken this low and be looking for trading opportunity around our 50 to 60 one level of retracement. You could have gotten this one, and this trade maybe you could have gotten 1 to 2 depending on where you put your stop loss and the time frame they are trading. If you go to smaller time frame, I think you get 1 to 3 or even 1 to 5 risk to reward from this trade here. So this is another way or another trade that we could have taken using the Fib retracement tool. We can also go to higher time frame where you see this trend very well, where traders, long-term traders, can also trade in these big moves. Let me give you an example here. If you move our chart a little bit forward, you could see also at this level, we can also the market was in a downtrend. Let's say a new trader using Fib as his tool, you can see around the 50 to 60 level of trading. When the market got there, you could have looked for opportunity there. So let's look at the last trade. You can see, let's say this trader also wanted to trade this last trade. Let's see around the 50 to 60 level, you can see the market did what? Give us some signs of reversals to the downside. As we go deep, you'll be talking about why this market did this here, but let's focus on the retracement here. If you look at here, we can see the market also retraced exactly to the 50 to 60 level here, but it broke up. Let's say if you should have taken this trade, you could have been in a loss for this one. As we were talking about the Fibs, we make mention that you don't have to. As we were talking about the Fib, we mentioned that we don't have to always rely only on the Fibs to make decisions, and add another confluences that we will be talking about to make decisions in the market. So let's say this trader will not trade on a 2 hour. A new trader who will not trade on a 2 hour, how will he approach this market? So a trader who does not trade a 2 hour or who will not watch the 2 hour can take this trade as this point. You can take it from this high to this low, and he will also be looking at these levels. He also be looking at this. When he see any signs around this here, like an indecision, he could be taking his trade around these levels. So thank you for watching this video, and please like this video. Bye bye.